How is everybody doing today? Welcome into a weekly recap video with the wheel strategy, where I go over my positions and my journey with the wheel strategy and show you the trades I take, the profits I make, and how you can do it too. On the screen, you can see the account value, you can see the positions, you can see the graph on my account value right here. This is the last month. So for the last month, it looks like it's from April 28th to May 27th, this past Friday. It's been pretty flat with dips and valleys and troughs and all that crap. We just ended this week on a dip, so not great, just above 25,000, and we're still dealing with the same positions we've been dealing with for the past couple months. It's been in a big rut lately. CVS, Bank of America, CHWY, and of course the newly added Suncor Energy, where I've been selling some puts on that one. 2 weeks successfully selling puts, and I have a third one already in the pipeline for next week. So we're going to talk about all those positions, but first, as always, we're going to get into the S&P 500. Figure out what that thing did, what we can expect moving forward, and I'll talk about the disparity between my positions and the S&P 500. So let's get into that right now. So here we have the daily chart of the S&P 500. It's pretty zoomed out. This is SPX, and I want to start zoomed out because I drew this big ascending triangle pattern here. So I already had this line right here for a while. This was that big descending trend line that we respected for the entirety of that downtrend for all of 2022. We did break through it to the upside, and we've been trending higher pretty much ever since the October lows right here. Zoom going up, up, and up, lower highs, higher lows. But when we really zoom out, this formation that is an uptrend could, and this is the bearish thesis, large scale, long-term bearish thesis, is that this uptrend that we've been experiencing for the past 5 to 7 months could just be a healthy retracement in an otherwise bearish downtrend, where you have this big bear pole followed by a little bit of an ascending triangle retracement that ultimately breaks back to the downside. That could be the situation. So I'm not saying it is, I'm just saying it could be. So I wanted to mark it to see how these levels were obeyed. The bottom line, you can't really say this has been confirmed on this point, because any 2 points of contact, I mean, you can draw a line on any 2 points. We only have 2 points of contact, so until it gets tested on a third time and is respected, this isn't necessarily a valid line. And the top line, we did have a little bit of a blunder here. This wasn't perfectly respected right here, but it does look like it's being respected more recently when you zoom in here on the pretty much the past week, where we rejected that level right here and right here on Friday. So I'm just watching this for now as a bearish thesis. The bullish thesis is already in play. There's really nothing to say there. The bullish thesis is that we've been making higher lows and higher highs for past 7 months. And the most recent higher high, although it is a higher high, we haven't really followed through yet. So there is still the chance that the bears stuff this 4,200 area and we don't really make a new higher high. But right now, the way the bulls keep fighting back, it looks like it's going to happen. So here's the week so far. I mean, the 5-day look was very strange. We started up here on Monday above, well, actually at 4190 and went above 4,200 for the second time. But then we sold off and failed to close above it. On Tuesday, we had this big 1% drop going down to 4150. On Wednesday, we had another 73 basis point drop down to 4114, as low as 4104. So we basically erased 100 points from the S&P over the first few days of the week, going down to 4,100 by Wednesday. A very big sell-off, a big rejection from 4,200. It was looking pretty bleak as the supply zone yet again held and caused a sell-off. But then Thursday, we popped up 0.8% back up to 4,150, and then on Friday, right back to where we were, 4,200, pretty much to start the week where we were. But this time, and more importantly, closing above 4,200. This is big. We actually closed for the first time above 4,200. We got above it a couple times. On a Friday and a Monday, we got above 4,200, but we never closed above it. This time we did. A very, very strong candle, 1.3%, closing pretty much near the highs, but we did reject off of this new line that I have, which is around 42.10, 42.12, which is, of course, where we rejected a couple weeks ago. So we're finding a bit of a double top there. This white line here, which is basically at the top of the supply zone, is significant. It marks a gap fill from way over here. If I zoom all the way back to August, you can see the gap that we created right here. So we gapped down on August 22nd, and we never filled the gap. The top was about 4,200, 4,205, and we sold off and never looked back. Now that we're back to 4,200, this gap is looking to be filled, although we haven't filled it yet. So what I'm going to do is I'm going to mark the bottom of this candle, and this right here, these two lines, these two white lines, marks the gap. That's the gap that we have to fill, or the bulls have to fill, the bear gap that the bulls have to fill. So 42.18 about is when the gap is filled, and we haven't gotten that high yet. So when I zoom into where we are today, you can see how we fell just short of this 42.18 area. So you can see the top white line is the gap fill. We've gone in the gap, but we never filled it yet. So there is some work the bulls have to do. And of course, if we do fill that gap, that's a big deal. That would be above all the supply zones, all the resistance lines that I have. It would be in the past, we'd be above all of it. We'd fill the gap, and that would give the bulls their real shot to send us higher and send us another leg higher. I mean, here's the first leg from the October lows. Here's the second leg, and we're trying to make this the third leg here. But you got to really break this high, the previous high, and go. Not just kind of break it by a few points and sell off. That doesn't really count. That just makes it more of a resistance range. We need to really break through it and start a new leg higher to continue this uptrend where we have lower highs and higher lows. So that's what we're looking at right now. A very strong close from the bulls. If you look at the 5-day look, so just this week, Monday through Friday, you can see just how crazy it was. Going up to 4,200, going all the way down to 41, going right back up to 42. A huge push Thursday and Friday in the market. But how did that go with my positions? My positions, Bank of America, CVS, CHWY. I'm long on all those names. The wheel strategy is a long bullish strategy where you're holding short puts or you're long shares. And in any case, you want the market and your positions to go up. And, well, the market went up. What did my positions do? Nothing. Diddly squat. They went down. And you know why? Because this whole market is being propped up by 5 names. Apple, Nvidia, Amazon, Tesla, Google. That's it. Big tech names. There's 500 companies in the S&P. And 1%, just 5 companies, is it propping this entire thing up, with Nvidia blowing doors off the world here, going up like 40%, up 150% on the year. Tesla, Amazon, Google, Apple near all-time highs as usual. Like, these names are going crazy, but that's it. Like, that's the only reason the market's going up. And it's working out that way because those names are huge parts of the S&P 500. We'll bring up a heat map from FinViz here. Okay, so here is FinViz right here. FinViz is a website. You can access it for free. It gives you good fundamental information about companies, and it has a nice heat map here that you can look at intraday. It is 15 minutes delayed though. Just a warning if you look at it intraday, but it is free. And right now, given it's just the weekend, this is everything I need. So it's all 500 companies from the S&P. It shows you whether they're up or down. So green if it's up, red if it's down. It gives you the percentage move on the day. And it shows you the size of the company relative to the others in the S&P. And that's based on market cap. How big is the market cap of these companies? The bigger the market cap, the bigger the square. You can see Apple is freaking huge. So $1 trillion company, it's a huge part of the S&P. It's like 7% of the entire index or something like that. And then Microsoft, Google, Amazon, Nvidia, Tesla. You can see how big those names are. So therefore, it is possible for 5 names to move the entire market because 5 names make up like a third of the entire index. So let's go to this is a 1-day performance. So this is Friday. let's look at a year-to-date performance. You can see just those 5 names that I mentioned. It might be a little more when we throw Microsoft in there, Meta, Tesla. But you can see the glaring green from just a handful of names, and then everything else is a wash. Everything else is honestly mostly red. Energy is red. Healthcare is red. Financials are mixed. Consumer defensive, mixed. Healthcare, already said. Utilities, red. Basic materials down here, kind of mixed. Industrials, mixed. GE looks like it's doing pretty good this year. Everything else isn't. So it's kind of a shit show everywhere except these handful of names. Big tech. So is that a healthy market rally? Is the market really doing well when it's just due to 5 names? I think I read somewhere where if these names, if like 5 names were stripped out of the S&P, the market would actually be down on the year, but instead we're up 9%. So is that indicative of a healthy bull market? I don't think so. But I can't deny the move from the S&P 500. Just look at this uptrend from October. It's looking pretty nice for 7 straight months. Like, that's a long time for it to be uptrending. I can see why the bulls would think that we're done. We're going higher. But when you really look at the big picture and how just a handful of names being up 38%, 35%, 117%, 41%, 43%, 56% for Tesla, 166% from Nvidia, it kind of looks like the foundation of this move isn't very sturdy. The whole 500 company index is being held up by 5 names. I don't know. I don't think that's very healthy. I don't think that's very indicative of a bull market. The market is moving higher. I can't deny that. But I'm not a big believer in this rally that we've been having. This short-term 7-month bull market, I guess you could call it, because that's when we've been uptrending. I'm not really buying it yet. Everything else is red. It's just a handful of names that are doing well. So we'll see what ends up happening. We could break out, there could be a week or two of a huge move. But in the bigger picture, 6 months from now, where are we going to be? Do you think we're going to be higher 6 months from now? Or are we going to be back down below 4,000? All right, so enough of that. Let's get into the wheel strategy. We'll bring in the graphic here. I'm at $51 profit for the month of May. Very slow as usual, but hey, at least it's something. I am realizing some profits while I wade through the water of this nonsense. And as I showed you, aside from those 5 names, the market is pretty much red. And that explains why my positions, even while the market's doing great up to 4,200, my positions are absolutely sucking. So let's actually start with the positive, and that is Suncor Energy, where I actually made some profits. So go to Suncor here. I have a line here for a put that I sold for this week. I sold the $27.50 for this week, expiring June 2nd, next Friday. Sold it for 21 cents. That's like the 3rd time in a row I've sold a put on Suncor Energy for 21 cents. Exactly. So I did it again. That's good. But for this week that just passed, I actually had a $28 put marked by this white line. I sold a 28 strike, and we were doing fine. We were doing great above 28 all week until Friday came. Go to the 5-minute chart on Friday. So we opened right here. This is the open for Friday. We were doing great, yada, 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 up in the high 28s, doing fine. Half the day is over. My put looks like it's going to expire worthless. And then out of absolutely nowhere, we tanked a full dollar per share below $28. All of a sudden, my put looked like it was pretty much worthless, just needed to go to the end of the day. It was all of a sudden in the money by like 40 cents. And I still don't know what caused that big drop. But we ended up recovering, and then we started to roll back over right here. So right here, when we recovered above 28, but then started to roll back down, I decided to close my put. I didn't want to hold it to the end of the day anymore. And that's partly because I already sold the next put ahead of time. I prematurely sold next week's put during Friday because I didn't want to wait for the current week one to expire and then open a put on next Tuesday. We've got a holiday Monday, so next week we're going to start on Tuesday, which means premiums are going to be deflated, or not deflated, but decayed an extra day because we're opening on Tuesday and not Monday. I didn't want to, I lose that extrinsic value, so I wanted to sell the put early. But I don't have enough buying power to buy 200 shares of Suncor. I only have enough buying power for 100, for one lot. So I couldn't risk taking an assignment on this contract at 28 and also have the possibility of being assigned down here at 27.50. So when I had the chance to close my put for a profit, I did. I took it. I took it off right about here when it looked like we were coming back down. And I closed it for 10 cents. I sold it for 21 cents, bought it back for 10, and I profited $11. We ended up holding 28 and literally just going straight up the rest of the day. These are 5-minute candles, and there was like 20 green candles in a row, going right back up to 28.60, right back where we were before that whole cataclysmic drop happened. Really don't know what happened there. Suncor ended up being fine, but I decided to close my put prematurely anyway because of the additional put that I decided to sell. So I have an extra put going on for next week, 27.50. It does have a dividend coming up this week, 38 cents, which means we need to expect Suncor Energy on the ex-dividend date to drop and open 38 cents lower than the day before. So there is a built-in 38-cent drop for Suncor this week, which is why I was able to get 27.50 instead of a 28 strike. I've been selling 28 puts for 2 weeks now, the 28 strike. This time I'm 50 cents lower for the same good premium because that dividend drop is built into the premiums. So I'm basically being paid that dividend up front in the form of extrinsic value, and I'm able to get a better strike at 27.50. And if I get filled there, you know, that'd be a pretty good spot overall. Looking at the weekly chart, zooming way out, here's the 5-year chart. I think this 27.50 area where the yellow line is a pretty safe spot, all things considered. So I feel good about that. We'll see what next week brings, and if I get assigned, I'll be happy. Okay, moving on to CVS here. Well, a couple of videos ago, I said the bottom is in for CVS, as this formation got me thinking, that's it. This big red candle followed by the giant green candle after it, and then we held it for a week after that. To me, it seemed like the bottom was in. I'm not the only one who said that either. Well, on Thursday, we made a new low, down to 66.60, and we kind of double tapped that low again on Friday. So CVS rolled right back over. But the new low that CVS made, if you look at the 1-minute chart, there was some funky business that happened. So I just got to zoom out on this 1-minute chart here, go to Thursday, and then zoom in. So here we go. Here is the 1-minute chart on CVS. Out of nowhere, just kind of like Suncor Energy, but in a lot faster, 1-minute chart, we had this massive drop, this huge like flash crash for a dollar per share, which doesn't sound like a lot, but given the candles before it, that's a pretty big drop. It was like a 1.3% drop in 2 minutes out of nowhere. And that's what caused the new low to be made on CVS. But you can see that candle was quickly, within the same minute, bought right back up. And then we rallied after that. Got right back above that, that drop area, and we pushed a little higher. So that's what created the new low in CVS. And obviously it triggered a ton of buying to prop it right back up to where it was and then some. So although, yes, it did make a new low, it did so in a very strange fashion, and it led to a huge snapback, which means a lot of buying took place while it dropped. I don't know if there was a glitch in the computer high-frequency trading world out there that caused it to collapse, but obviously a ton of buy orders came in at that low, which I said the bottom was in at that area, to prop it right back up. So I think there's clearly a ton of support here at 67. And we tested it again on Friday, right here, $67, and it caused us to rally again. We found a bottom. So whether or not the low was in, you can debate it. You can debate the fact that that was the case because obviously we made a new low. $67 seems to be some pretty strong support. So I am praying to the trading gods out there, to the healthcare gods out there, any gods that are out there, let this be the bottom for CVS. For the love of God. Why does it need to be crushed this hard? I don't understand it. So that's all I got going for me right now. Let's see if we can get back to $70 anytime soon. That'd be pretty cool. Moving on to Bank of America here. This is a little bit of a better story. My break even's at 28.87 now. I sold a covered call this week because on this day, Tuesday, we had a pretty strong day, didn't we? This is a nice day. Got as high as 29.04, above my break even. And I took that bullish green day, that momentum. I took advantage of it by selling a covered call. Selling calls into strength is the way to go. I sold the 29.50 level, which is right about here, right where the white line is. I sold a call right there. And you can see we didn't threaten that call at all. In fact, we sold off quickly after I got filled at that call. And then we sold off the next day after, down 1.6%. And then we gapped down even lower than that the day after. So I ended up closing that call early. I sold it on a Tuesday, so midway through the week. I collected 13 cents. I closed it for 2 cents. And I captured 11 cents total, about 90%. That helped me lower my break even by 11 cents, and now my break even on 200 shares is at 28.87. And I don't have any calls sold on it. We do have a dividend coming up this week on Thursday. We got a dividend of 22 cents. And I have 200 shares, so I'll be getting $44 in dividends coming my way, and I'll be able to reduce my cost basis or my break even by another 22 cents because of the dividend. Now the stock should drop by that 22 cents to compensate for that benefit that I'm getting because the market's efficient. There's no free lunch. But I'm hoping that the market can recover that drop and, end up being a net positive for me by lowering my break even. So that's what we got going. Can't really sell calls yet, even though we look pretty close to my break even. It's just not paying enough premium. So we just got to hold on a little longer, but the chart's not looking too dangerous. We're obviously bottoming out here on 28. I just need some momentum. I mean, you would think the market going up to 4,200, going up 2% in 2 days would push Bank of America up, but no, it didn't because it was only based on 5 names in the market. But enough of that. Moving on to CHWY, the last one here. This one's interesting because we have earnings this week. Earnings on Wednesday. Wednesday night, CHWY has earnings. Now, I was hoping to be able to sell a really nice call this past week, like Thursday or Friday. I was really hoping for CHWY. I made a video on Wednesday, which was right here. This is Wednesday. I made a video on this day saying I really hope that CHWY on Thursday and Friday can start to rally a little bit, maybe at $33. That gets me closer to my break even. It will get me in a beautiful spot to sell calls into earnings. CHWY will be at a higher price. I'll be able to get a really nice call for a great prop premium, possibly like 60 to 80 cents on one covered call, way out of the, far out of the money, because the premiums are pretty high. The volatility is high with this one. So I was hoping for a nice rally at the end of the week to get a really nice call for a good premium. Instead, we sold off. We dropped 4.5% on Thursday to make new lows for CHWY. And then we did it again on Friday, made even lower lows down to $29.80, got below $30 per share, and continued to make new lows. We did rally a little bit, closing at $30.50, but ultimately lower than we were on Wednesday when I was saying that I was hoping CHWY would go up. Instead, it went down, along with 495 other companies in the S&P 500. So that sucked because that made it so I wasn't able to really take advantage of earnings premiums. So, I mean, I was able to sell a call above my profit, above my break even. So my break even is at $34.56. I sold a call at $35.50. So that's about $1 in the profit zone. I collected 34 cents, which is a pretty good premium for this price stock. My boxes were checked, so I can't complain too much. But I was really hoping to take big advantage of this earnings premium because if we did rally up to $33, I would have been able to get like the 36 strike, even higher into my profit territory, and I would have been able to get like 60 cents, like so much more premium, a higher strike, everything, or the same strike for a ton more premium, maybe like $1 in premium, which is huge for a stock this cheap. But unfortunately, we moved lower, which meant the out-of-the-money calls were getting cheaper and cheaper, and I wasn't able to get a huge amount of premium like I was hoping for. Earnings is on Wednesday, and I'm hoping for some positivity because if we dip and drop like 10%, then that's really going to suck. But I just have 100 shares, and I do have the ability to add to it if I need to. So if it does drop, we'll take advantage of that, possibly. But for now, let's just hope that it goes higher. So that's going to do it for this video, this weekly recap. Next week is another week of May, but it also goes into June. Thursday is June 1st, Friday is June 2nd. But the majority of the week is May, so I'm still counting next week as a May week. So I still have one more week before I wrap up the month of May and we do a monthly recap. So let's see what can happen this week. Let's see if we can get some more profits. That'd be cool. Maybe CHWY's earnings causes a huge rally and I get out of that thing and collect some profits, take some positions off the table. Who knows? I'm down $500 in my CHWY position. If I'm able to close it for a profit, that's going to be like a $600–700 swing to the upside for my account. So that would be very massive. But I'll check with you guys on Wednesday. That'll be when CHWY reports earnings. And until then, that's going to do it. So thank you guys for watching. If you enjoyed, hit the like button, subscribe for more content, and I'll see you all next time.